We are currently in one of the largest global banking crises in the world. Within the past 72 hours, regulators made the second largest bank seizure in United States history, which resulted in the largest banking failure since 2008. This is the story of the Silicon Valley Bank. SVB was founded in 1983 and throughout 40 years grew to be one of the largest banks in the United States with over $210 billion in assets. The success of SVB wasn't just limited to capital growth. SVB grew a client list of massive names in the tech industry, such as Airbnb, Cisco, Fitbit, Pinterest, and the payment processor Square. But unfortunately, all the success would eventually go up in flames. On Wednesday, March 8th, 2023, SVB was in trouble and they needed a way out. Due to the recent performance of the tech sector and the interest rate hikes, their securities lost an immense value over the past year. So, they did what every other bank would do, and they announced to the public that they needed to raise a whopping $2 billion in capital in order to keep their head above the water. 24 hours after the announcement, SVB shares began to plummet. The stock price fell so hard that the CEO of SVB, Gary Becker, begged and pleaded with his investors to, quote, stay calm. Gary Becker insisted that the bank wasn't in any real danger of collapse. The only danger was the rumors. However, shortly after his public statement, billionaire and tech guru Peter Thiel warned the public to withdraw their funds from SVB. By the end of the day on Wednesday, SVB shares had fallen by over 60%. On Friday morning, 2 days after the first announcement from the CEO Gary Becker, CNBC reported that SVB was unsuccessful in their venture to raise the $2 billion they needed. This resulted in an all-out bank run. SVB customers withdrew a staggering $42 billion of deposits, which put SVB in a negative cash balance of $958 million. This was so bad that SVB called the New York Police Department on Friday morning because their customers were lining up outside of their Park Avenue office to withdraw their own money. By noon on Friday morning, United States federal banking regulators had seen enough, and they announced to the public they were seizing the SVB deposits and putting the bank into receivership. Unfortunately for the customers who weren't as lucky and couldn't withdraw their funds, there is no guarantee that they will ever see their money again, since the majority of deposits that SVB held were uninsured. So where does this leave us? Since the collapse of SVB, we've seen an immediate consequence in both the stock market and the crypto markets. Currently, the Federal Reserve is set to raise another round of interest rates to fight ongoing inflation. By doing this, the total money supply available will begin to shrink at an extremely faster rate. Other key metrics, such as the labor force participation rate of the United States, is sitting at an extreme low of 62.5. The United States labor force hasn't been this small since 1977. Furthermore, the U.S. debt to GDP ratio has been skyrocketing since 2020 at rates we've never seen before. Over the years, we've become so numb to financial crises, but it's safe to say this one is different. With each passing day, the United States debt continues to grow. More and more banks continue to collapse, and more people continue to struggle with maintaining their bills and necessities.